The broadcast is now starting. All attendees are in listen-only mode.
Hello everyone, thank you for joining us today for our 2015 First Quarter in Review webinar. I'm Sheldon McFarland, Vice President of Portfolio Strategy and Research at Loring Ward, and I'll be your host for today's webinar. This webinar is provided by LWI Financial Inc., Loring Ward, an investment advisor registered with the Securities and Exchange Commission. Securities offered through Loring Ward Securities Inc., member FINRA SIPC. Our presentation today will last approximately 30 minutes, followed by a 10-minute Q&A session at the end. To ask a question, open your GoToWebinar control panel by clicking on the orange arrow icon. Type your question into the question box and hit send. Feel free to ask questions at any time during the presentation. Your questions will not be viewable by other attendees and will be addressed during the Q&A session at the end of the webinar. I ask that you keep all questions general in nature and refrain from submitting questions pertaining to your specific investment situation or portfolio, as we cannot answer them on this webinar. All participants will be in a listen-only mode for the duration of this webinar. We worked hard this quarter to revamp our quarter in review format. We've redesigned the presentation to spend less time talking about the past and more time preparing you for the future. So sit back and enjoy our journey over the next several minutes. I'm excited to have with me today Matt Carvalho, Director of Investment Research, and Loring Ward's new Chief Investment Officer, Pyle Farasat. Matt, Pyle, welcome.
Thanks for having us.
On March 9th, we celebrated the 6-year anniversary of the stock market rally measured by the S&P 500 index, the common index used to measure the performance of the U.S. stock market. Since its low back in 2009, the market has rallied 220%. So congratulations. Yay!
Yay.
Everyone who remained invested during that time, patience and discipline were rewarded. But after bull markets come bear markets, then flat markets, more bull markets, more bear markets, et cetera, you get my drift. And given it's been so long since we've seen much in the way of turbulence in the markets, I ask, are you prepared for a bear? No bull lasts forever, or at least that's what the historical data tells us. This chart here shows every bull and bear market defined as a 20% advance or decline in market price since 1926. The bull markets are highlighted in blue and the bear markets are highlighted in red. And as you can see in the data, bear markets, though not as protracted or profound as bull markets, do happen. We can't predict markets, but we can prepare for them. This bull market could continue another 6 years or another 6 weeks. We just don't know. But either way, we want to have a game plan of how to proceed through the next market downturn, whenever that occurs.
You make a really good point, Sheldon. No one can predict markets. So let's focus our attention on preparation versus prediction. And I believe right now is the time to prepare. You may recognize the field manual, long issued by the U.S. Army. It's a simple guide for surviving a variety of dire, unexpected scenarios. The key concept of a field manual is that people need to be aware of the information and prepare in advance. At Loring Ward, we strongly believe that the benefits of an Army survival manual can apply rather well to the financial world we live in today. In fact, many investors often find themselves shell-shocked by the negative impact of corrections on their investments. And they scramble for a game plan, or worse yet, they scramble for an exit strategy when they're already in the midst of a market meltdown. So just remember that it's really healthy for corrections to be expected from time to time. And since we've noticed that stocks have gone over 520 days without a 10% correction, the time is right now, when performance is not an issue, to think about a bear market and to think about our potential overreactions as investors who can feel caught off guard. So let's apply some of these Army concepts to our investing today and prepare ourselves in advance, just like the U.S. Army does. So on behalf of Loring Ward, Matt will next present to you the Bear Market Survival Manual. Step-by-step instructions and illustrations to help you prepare for the inevitable, yet temporary, market declines. So before we kick off the review of Q1 of 2015, we'll go over what we found as time-tested and field-tested investment techniques and survival skills that we believe every advisor and every investor should know. Matt?
Thank you, Pyle. And as you mentioned, over the next couple of slides, we're going to walk through that survival acronym, letter by letter, starting with these explanations that you see provided by the Army Manual, and show how each of those actually relates to investing, and particularly during bear markets. So let's start off with S. Size up the situation, know your surroundings, physical condition, equipment. And we never know in advance just how long a bear market will be, or even how long it will last. But we can look to history as a guide for a wide variety of experiences. Now, the study we're bringing up was done by Morningstar, and they looked all the way back to 1926 to find a wide variety of stock market declines since that time. And what they're showing here is the length of a downturn, so how many months it lasted for, the percentage loss, and then the amount of time it took to recover. So you see everything from the Great Depression at the top here to the most recent financial crisis here. And we know that even though investors in something like an S&P 500 type of allocation lost 50% of that stock exposure, that happened during a mere 16 months, and they actually recovered about 3 years later. Now, chances are, no matter how miserable a current bear market feels, we're likely been through worse over time. And when we look at these numbers, we actually found that the average downturn lasted only 13 months, saw an average loss of about 28%, but what was most eye-opening was that that loss was recovered in about a 2-year period. So in all, it took about 3 years for the market to have that bear market, to have that decline, and then to recover all of that lost value. So a much shorter time horizon than I think we typically associate with bear markets. So next we'll go on to U. Use all your senses. Undue haste makes waste. In a real-life survival scenario, your senses or gut feeling may help guide you down a safe path or somehow keep you out of danger. But in the investing world, those same feelings can often hurt our portfolio performance. And here's a real-life investment example. What we're looking at here is the bar chart shows the amount of money being put into U.S. mutual funds invested in the U.S. stock market year by year or month by month here. And then the line graph is actually the S&P 500 level. And what we see is that investors are pouring money into the market as the market's already risen, and then withdrawing those same funds after the market's declined. So basically buying high and selling low. I think all of us can know that's pretty intuitively a bad way to invest over the long term. Now, there's always going to be something to fear in the market, right? Everybody was worried in 2008 or 2009. Whether it's a government shutdown, the Fed raising rates, or the impact of a strengthening U.S. dollar. But it's precisely because of those risks that we can expect a higher return on our investment portfolios than we would from a simple bank CD. So by foregoing haste and instead practicing patience, we will be better prepared to ride out the market's ups and downs.
Matt, if I can chime in, who remembers Y2K when computers were going to fail? I mean, seems unbelievable today, right? Did you know that year 2010 was dubbed Y2K plus 10 or Y2.01K by the media? I mean, it seems crazy today. But my point is exactly the same as Matt. There's always going to be some quote-unquote bug or noise or the other in the horizon. Don't let these fads deter you from your mission.
Those are great points. So we'll move on here to R, remember where you are. And the simple premise behind financial planning is really just the idea that you're at point A today in terms of wealth and time, and at some point you want to get to point B at a future date. Yet the mistake that many investors make is to assume that that path is going to be a perfectly straight line. But in reality, we never earned the average return. 2014 was slightly lower for global portfolios. 2013 was far above. So we're going to have those peaks and valleys here. We're going to have down years or bear markets along the way. But we need to remember that even though we have those good years and bad years, those are accounted for in a long-term investment plan. And we need to keep that in mind to help keep us on track, even though sometimes we might be behind schedule, other times we might be ahead of schedule.
Keeping it really simple, think of the fact that being financially responsible requires you to remember only 2 points of time, where you are in the present relative to where you need to be to meet your goals. That's it. There's only 2 moments of truth in investing that matter. And who says that you should take the more pleasant, scenic route to your destination? So let us help you own that diversification, to own that risk. And then you keep invested, stay the course, because everything else really is quite temporary.
And I think staying the course is really the key component here to the idea of V, vanquish fear and panic. Because we need to acknowledge in advance that the market declines are going to trigger some strong emotions. And if we can know that in advance, we can anticipate and prepare for them whenever that bear market does occur. So here we've brought up what we call the cycle of market emotions. And really this is the idea that when times are going well, we're going to feel optimistic, excited, elated, right? This is a great time to buy. The stock market just can't lose. We're earning double-digit returns every year. I need to invest more and more into that exposure. But yet we know that's actually a very risky time to be piling into the market. Contrarily, when things are going bad, we're going to start to feel nervous, alarmed, frightened. Back in 2008, the future was so uncertain. There was nobody out there telling you that the next 6 years were going to be a fantastic bull market and we're all going to have above average returns for quite some time. But when we look back historically, we see time and time again, those periods when everyone is frightened tend to be the greatest potential opportunity.
Investing is a lot like life itself, if you think about it. It's instinctually emotional, boring, euphoric, depressive at times. So there are 3 proven techniques that can inoculate us against these emotional investing patterns and the pitfalls of that. And some of those are, 1, to continually dollar cost average into upward and downward trending markets as we save. So not only to save, but to dollar cost average into markets. 2 would be to rebalance periodically and systematically so that we're taking profits off the table with the winners and we're forced to buy the losers. And 3rd would be the simplest one, which is staying diversified. Diversification, as I think of it, is your downside protection buddy. So what Matt just showed you is precisely why we recommend every investor to work with a professional, an advisor, who can help you keep the emotions at bay while you're investing your nest egg.
Great, so we'll move on to I, which stands for Improvise. Now, often the numbers involved in financial planning can seem overwhelming. You have accumulation values, time horizons, distribution rates, taxes. It's tough to really see where you as an investor can make a real impact. But what we often find is that those clients with some flexibility in their plan to improvise in small ways along the way can see large impacts in their likelihood of long-term investing success. So what we wanted to show is just an example here of an investor who had $1 million in a portfolio and they were looking to retire today and withdraw $50,000 a year, adjusted for inflation, over the next 30 years. And when you run thousands of different scenarios with different types of market returns, you find out that they're successful about 3/4 of the time, or they don't run out of money. Basically, they don't have to change their lifestyle over that 30-year time frame. But yet, they might not feel that comfortable with that. Perhaps we've been in a bear market the last year or two, and so that $1 million is actually down from a larger portfolio value that they used to have, and they would feel more confident going into retirement if they could increase that number. Well, there's a lot of somewhat minor changes that you can make. One of those is to maybe retire a year later or have some type of consulting or other income to not have to withdraw from the portfolio in year 1, and then be able to find a way to maybe minimize some of those expenses just a little bit in retirement so that you only need to start off withdrawing $45,000 a year instead of $50,000. And you can find that by making just those 2 relatively minor changes in the scheme of things, you can actually increase your likelihood of not having to change your lifestyle in retirement from 74% to 87%. So let's then talk a little bit about V, which stands for value living. And to us, this is really the idea that you need to remember what you're investing for. Perhaps it's a vacation home to host family reunions at, education for a child or grandchild, or a bequest to a charity upon your passing. You know, I'm thinking back, just last night I was looking over this presentation, and I was also taking care of my 2-year-old daughter who currently has an ear infection. So she's got the fever, cough, basically just in a miserable spot. And as a parent, you would really want to do anything you could at that time to try and help them out. And really, I was thinking that's why we come to work and why we invest and save every day, right? We're trying to fund that education account, live in a house in the right school district. We want to be able to have the money for those family vacations to create those memories, or make sure that we have a big enough nest egg that we're not a burden on them when we go to retire ourselves. And we're doing all those things instead of just going out and buying a fancy car today or just spending the money right away. So at the end of the day, we need to remember that we should not only value our own life, but also the positive impact we're going to have on so many others by keeping that long-term investment perspective.
Now, speaking of family, you see risk and return are like siblings, right? So there's some deep sibling rivalry that's going on there all the time. So in order for us to see the merits of investing, we really have to feel comfortable feeling rather uncomfortable. And I think that's the key to keeping it all in perspective.
Great. So let's move on then to A, act like the native. Now, we all believe we live in the best country in the world. And whether we live here, in Australia, or in Brazil, chances are the majority of our portfolio is comprised of investments in your very own country. Yet by doing so, we're missing out on many opportunities around the world. For example, over the last 10 years, many people would have trouble guessing that the Philippines, Peru, or Indonesia actually had the best returns over the last decade. And when we look over that same time period, we find out the U.S. was basically in the middle of the pack here, coming in 20th out of 44 developed and emerging market countries. So when preparing for bear markets, we need to realize that the returns of all those countries don't occur at the same time or in the same magnitude. And so by maintaining exposure to the entire globe, we're going to be better prepared for bear markets.
Matt, I get asked a lot about Russia lately. There's a lot of uncertainty there. On paper, it looks really bad with plunging oil, recession, unstable Putin himself, sanctions, geopolitical issues, as well as a collapsed currency. However, if you peel the onion like you should with everything, where these very factors go next is where Russia's headed, and many see opportunities. So you have to do your own gut check to know whether or not you have a tough stomach to act like a global native despite the micro headlines that'll come your way.
Great. I think that leads right into our last letter here. L, live by your wits, but for now, learn basic skills. So when investing, one basic yet critical skill is to realize that your time horizon is likely far longer than you expect. Very few of us will be completely liquidating a portfolio in the very near future. So we wanted to answer the question we've received many times over the last couple of years. Is now a good time to invest? Well, as an eternal optimist, I would say now is always a great time to invest. But let's go and actually look at the facts. So we went back and looked since 1972 at daily returns on the S&P 500 and looked for new market highs. So times when you would have seen in the newspaper S&P at an all-time high today. This just happened last week. It's happened actually 566 times since 1972. So what would have happened if you had invested right at that very market peak? Well, if you'd had at least a 5-year time horizon, which I think just about everybody would have, and were able to hold on for that time with an investment of $100,000, your worst case scenario was you ended up with $80,000. So losing about 20% of the portfolio, certainly not great, but yet maybe not that catastrophic of a result. The best case was actually a return of that $100,000 into $337,000. But probably more useful is the simple average here, in that in most cases, the average of those 566 occurrences, so this is a lot of data in our sample set, you would turn that $100,000 into $178,000 over just a 5-year holding period. Now that's pretty similar to historical market returns. And I think that really tells us that, you know, regardless of where the market is, if you have a meaningfully long time horizon, you're going to be able to capture those market rates of return regardless of if we're at a new high or not today. We also looked at what would have happened if you'd switched out of stocks. So if you said, okay, stocks hit a new high, I'm convinced they're going to go down from here. Well, if you had sold those stocks and bought into bonds, your average return was to turn that 100,000 into 147,000. So not bad, but far below the 178 you would have seen had you just maintained that exposure that you likely already had, and actually far better than if you had turned that stock exposure into gold, which actually lost money on average over 5-year periods following new stock market highs. So we've now gone through the 8 letters of the survival acronym and shown how concepts of each can be applied to investing. And we really want to stress that by following these guidelines, you can prevent turning those temporary declines of a bear market into permanent portfolio losses.
This concept of a bear market survival guide, I love it. I think it's great. It's a smart idea, and preparing now is key. Let's shift gears a bit. Now let's take a look back at what happened last quarter.
Okay, so we'll start off, Sheldon, here with looking at the news headlines for the quarter. And this, again, is a chart that we've created that basically just sizes the headlines according to the frequency of the term here. So you can see something like oil was the most mentioned term in financial headlines over the first quarter of 2015. And I want to pull out just a couple that I found interesting. One in particular headline from the AP on January 5th simply said, "Bears strike, stocks plummet and crude collapses, Greek drama." Now, this is often the sentiment you'll hear from the media, and it's probably a bit sensational to say the very least. But if we look at here, we see some familiar terms really sticking out. So certainly oil was in the news predominantly during the quarter. The Fed was mentioned quite a lot as people wondered what their next steps would be. And Greece was also in the news quite a bit. But all of these, taken on their own, are pretty interesting to look at. So oil was definitely mentioned the most frequently as it continued to fall in the first quarter of the year. It actually came back a little bit in April, so it's about even for the year. But at the end of the day, positive oil is generally viewed as pretty positive for the economy. A lot of input costs go lower, inflation trends downward when we have lower oil prices. So it's hard to see that that's really a negative for all of us when we're spending less money at the pump. And then when we look at the Fed, well, they've really set the stage to slowly start rate hikes later in the year, but we don't know exactly when that's going to be. And I think people lose sight of the fact that they're only going to start to raise rates once they feel the economy has recovered significantly. And then finally to Greece. Well, they're still in trouble. They're still having trouble meeting some of their financial deadlines. But the Europe financial system is now far less exposed to them than they were a couple years ago when we first started to worry about Greece. And I just want to point out that Greece, just as a percentage of the European Union, is less than 1% of the overall GDP there. So we just have to keep some perspective around there, that there certainly could be a lot of uncertainty if something was to happen, but at the end of the day, it's a relatively small amount of the economy there. So let's take a look then at what the quarterly numbers actually were on the markets. What we're showing here are some different asset class returns. So these are really just groups of investments with similar characteristics. And we see in the first quarter, U.S. REITs actually led the way, gaining 4.7%. So the strongest returner of 2014 had kept that momentum through the first quarter of this year. And then we go on, we see some things like U.S. small companies, international small companies, or international large value companies were actually the next best performers. And what was interesting were these were many of the basically laggards in 2014, the performers that did the worst around the world. And when we look at the international returns, what was interesting to see was that the U.S. dollar continued to appreciate during the first quarter here, actually quite significantly. But we actually saw returns on international investments in the local currencies. So those exchanges in Tokyo, in London, in Frankfurt actually grew by about double digits. So even when you accounted for the U.S. dollar appreciating, you still saw some meaningfully positive returns there. And then as we go down the chart, we see U.S. large, basically the S&P 500, short-term bonds returning 0.5%. EM value was one of the lowest returners here at 38 basis points, or 0.38%. But what's interesting is just in the last month now, in the month of April, we've actually seen emerging markets gain over 10%. So it just tries to always keep in mind this idea that these returns are going to be very random. So we can see exactly where 2015 slots in compared to previous calendar years. And as we were discussing, some of the international exposures here were actually the best performers in the first quarter of this year, while they were the worst in 2014. So it really just brings us back to the idea that we want to have a globally diversified portfolio, because nobody's able to predict which one of these is going to be the best performer in the next day, the next quarter, or the next decade. But we do want to be able to have that diversification so that we can prevent any of those catastrophic losses that you won't be able to recover from, and to be able to smooth out the ride over time. And that's going to have to be able to help keep us invested and reach those long-term goals that we have.
You can be more spot on, Matt. Personally, I love the Skittles chart because it illustrates what we know as fact, and that is that markets are random and they're unpredictable. And there's no shortage of headlines and predictions, noise out there. Our viewpoint is that advisors and investors should prepare now when markets are good. So we've created a simple manual for you, a cheat sheet, if you will, that you can easily laminate, pin up, and follow through with us. Here is Loring Ward's 360-degree survival manual of the bear market. S stands for stay calm and carry on. Be patient and stay disciplined in your investing approach. And I know this is more difficult to do than say, which is what makes it a key to your investing success. U stands for understand your risk tolerance. Be honest about the risk, the losses that you can stomach. And please update your risk assessment questionnaire today and again annually. It's imperative that you revisit this process. Very important. R stands for revisit your goals. Steer clear of greed and also of fear. And be realistic about why you're investing. You're not investing to tickle your ego. You're investing for your goals, so figure out what time frames you have that are important to you. Update and execute your investment plan accordingly. So stay executed. V stands for visit your advisor. Get professional guidance and perspective. Schedule a meeting with your advisor today and start having these conversations now so that you're fully prepared should markets turn the tide. I stands for in it together for the long haul. Here is where we believe understanding the difference between volatility and risk is paramount. And know that for every terrified seller in a bear market, there is an optimistic buyer on the other side of the trade who sees the same market as an opportunity. So like Matt said, don't turn your short-term volatility into your permanent losses. V stands for validate your financial plan. You have a plan. Now it's time to check it periodically. Your goals, your risk tolerances, and your appetites should align perfectly well with your expectations and your financial game plan. So update your plan today and again, revisit it annually. A stands for allow for change. Be open-minded and flexible to make adjustments that may be needed to improve your probability of success as an investor. Like Matt said, small changes can make a big difference. And only focus on what you can control. There's no point worrying about what we cannot control. And last but certainly not least, L stands for look to the future. We at Loring Ward help you own your diversification. We help you own a slice of tens of thousands of great companies, thriving businesses around the globe. Not equities, not stocks, but companies and businesses. As corrections happen and downturns occur, look through that lens of ownership. Innovation is always alive and well around us, and as long as that is the case, the future of investing in a globally diversified portfolio that matches your goals and risk budget is always, always bright. So now you might have heard this before, and it's worth recapping in my mind, but no one can forecast economies and no one can time markets. So Peter Lynch has said something that has always resonated with me. More money has been lost trying to anticipate and protect from corrections than actually in them. So just remember that the long term is really more obvious than you think. So let's plan well and think long term. Let's keep calm and invest on.
Matt, Pyle, thank you for a great presentation. I loved it. Fantastic. Now we're going to shift gears again and move into our Q&A session. Once again, to ask a question, open your GoToWebinar control panel by clicking on the orange arrow icon. Type your question into the question box and hit send. Your questions will not be viewable by other attendees. First question I have here, does it still make sense to invest internationally if the US dollar continues to appreciate?
Sure, Sheldon, I'll take that one. And really, that's a question we've been hearing quite a bit this year because the US dollar had such a strong, really 2014 and even into the first quarter, it continued to strengthen. You've probably seen headlines about the euro being at a more than a decade-long weakness. But really, when you take the long-term perspective for investing and acknowledge that currencies are going to go up and down every single year, it was a little more apparent because of the magnitude of it in 2014, but it actually impacts portfolios every single year. But it's not always going to be negative or positive. In fact, if you look back at the dollar all the way back to 1973, it's only changed in aggregate by a couple percentage actually depreciating against other currencies. Now, there's going to be years when it helps. Say in the early 2000s, it was a huge benefit to a portfolio. The international holdings that you had were increasing in value in their local markets, but they're also getting these double-digit bumps from the dollar depreciating at the time. So there's going to be times when it helps, times when it hurts. Just looking at April so far this month, the dollar's actually depreciated by about 2%. So it's been interesting to see that there's going to be times when it helps, times when it hurts. But at the end of the day, there's not a long-term expected return there. The dollar's not always going to appreciate or depreciate. And similar to the markets, nobody's able to time those. And so we feel you're better off taking that long-term perspective, acknowledging most years are going to be much less of an impact than 2014, but there's going to be times when it hurts and times when it helps.
Another question here. If the Fed raises rates this year, how will that impact my portfolio?
I can take that one. See, the Fed raising rates is something that's been something we've been exposed to for a long time now. Think about it as being priced in already. What's not priced in is if the Fed hikes rates in unprecedented ways, which is very unlikely to happen. But should that happen, should there be an unprecedented hike or no hike at all, which is what is happening in the media now, is thoughts that maybe the Fed's not even going to raise rates as expected. That's why you have bonds in your portfolio to offset the stocks and to create this diversification. Because with bonds, there's this inverse relationship. As rates go up, the prices of bonds fall, and as you're on the shorter end of the curve, the smaller your duration risk. Even as rates go up, those short-term, high-quality bonds will actually be affected less. So at Loring Ward, we try to keep you at that end of the curve, only because we think of bonds as volatility dampeners. We're not trying to squeeze excess returns out of them. We're just trying to dampen the volatility of stocks, which are doing the risk-taking for you. And so should Fed raise rates, you shouldn't be affected much. Should Fed unprecedentedly raise rates, again, you'll fare way better than people that are in way longer-term bonds.
Another question here. The title of the webinar is, Are You Prepared for a Bear? So given we have a diversified Loring Ward portfolio, what else should we be doing to prepare? Great question, and I love the fact that the person realizes that most of the work's already been done. If you've got a globally diversified portfolio, which investors here at Loring Ward have, you're most of the way there. The preparation really comes on the emotional side and being prepared for the onslaught really that you're going to see in the headlines, because I guarantee you the media is going to paint the picture as the end of the world. So being able to stay invested and stick with your plan, that's what you need to start preparing for now, as well as talk with your advisor about some of those changes that you may need to make. Now, we can't control markets, and when markets go down, that's not a reason that we want to get out and change the allocation. But going back to the presentation, those variables that we can control, like our spending, our goals, desires, why we're investing, sit down and talk with your advisor about those things now. Get those things in your plan so that when a bear market does come, you are prepared.
And if I could add to that, I think it's also a question about revisiting your plans, your risk assessment questionnaires, revisiting your portfolio allocations, and making sure that you just get a quick refresher on where you had left it last and make sure it's up to date. I think that's the key, is to just revisit that. And for advisors to reach out to their clients before the headlines hit and talk about these difficult topics like bear markets and market corrections and downturns and updating those risk assessment questionnaires. It's a great way to really collaborate on such a negative headline concept, bear market.
Another question here regarding international currencies and hedging within the portfolios. What's our strategy?
Sure, I can follow up with that one. And basically, back to the kind of idea that over the long term, there's no expected return. So we don't expect the U.S. dollar to appreciate against the euro forever, or the euro to appreciate against the dollar forever. So if you know that there's no expected return to be had there, and we also know from looking back into history that the correlations are different. And what I mean by that is that whenever international markets are up, doesn't also necessarily mean that their currencies are up. In fact, last year was a great example of that. International markets actually rose in their own local currency terms, but their currencies depreciated, which put them into a negative here. So because those things aren't perfectly related, meaning they don't move the same way at the same time, there's actually some diversification benefits to be had there. There's going to be a year when international markets are actually down in their local currency, but if the U.S. dollar is also depreciated, then you might actually see a gain on those international investments. And so if we think about it that way, where there's not really any expected return, there is a cost if we went out and tried to hedge each one of those exposures over time, and those are going to vary widely as stock markets around the world move and as currencies around the world move. So we would rather not incur a cost to hedge something out that doesn't have any expected return one way or the other. Over time, we think as long as you can keep that long-term perspective, as long as you can do those rebalancing, evaluate your portfolio over time, you're going to have a better long-term solution than trying to, guess or hedge out the currency time and time again.
Got a couple of questions here related to international diversification within the equity portion. Asking, one, what's our suggested percent in U.S. versus international, and also how do we approach that question?
Sure, I can keep. It is a question we've definitely heard a lot over the last couple of years now, and so at Loring Ward, much of the research we've done has said there's a lot of diversification benefits from having international exposure. So a lot of the companies around the world, if you look, over 50% of the stock market capitalization is outside of the U.S. So if you ignore all that, you're really missing out on a lot of opportunities. Now, as far as what percentage, well, most people may not be comfortable with actually half of their allocation outside of the U.S., but we think somewhere between that 30 and 50% range really allows a portfolio to capture that diversification benefits. You're going to have times like we're seeing in the first quarter this year when the domestic stocks are relatively flat, but international returns are much higher. That's really benefiting portfolios. So by having a meaningful chunk in those international allocations, you're able to capture those returns. You're able to dampen volatility for the long run because those returns are going to happen at different periods, and you're really going to basically get the best of both worlds. So there's going to be years like 2014 when you wish you hadn't had that international exposure, but if you take a longer-term perspective, it becomes very clear that that's actually very helpful for a portfolio.
We're about out of time, so we've got time for one more question. There's been a few questions that have come in regarding the presentation and its availability. And another question, even asking for a copy of the guide, the well-worn version of it. So let me start by saying the copy of the presentation will be available, as well as this recording, on our loringward.com website. You'll be able to see that there on the home page on the right-hand side. So as soon as we're done with this recording, we'll get that posted. As far as a copy of the guide, you can use this presentation as that guidebook, but I would also tell you and recommend that your investment plan, that really is your survival guide. And it should be well worn. Hopefully you've gone back to that and reviewed it often and frequently, and especially during bear markets, that's the first place you want to go. Go back to your plan. Take a look at what your goals are, your portfolio, because that plan was put together taking into account bear markets that may come into the future. So with that, this is going to conclude our presentation for today. Once again, we can't predict markets, but we can prepare for them. And our experience tells us that a successful investing experience is goal-focused and plan-driven. So prepare now for that bear, because it will come eventually. We don't know when. And when it does, stay focused on your goals and not the markets. Until next time, goodbye. Thank you.
Thank you.